Hi everyone, it's Z here. I hope you are great and I hope you're doing great in terms of trading and everything. So, I'm going to start a whole new series of technical analysis and I'm going to give you my experience and how I use different indicators, how I use different tools to do my analysis. So, first, we are going to discuss the very first indicator which every newbie learns about, and somehow I have seen that not everyone gets the real knowledge about it. So that is RSI, Relative Strength Index. It's an oscillator which moves between the values of 0 to 100, not touches the extremes though, but there are overvalues and undervalues for this. Like they have marked here in the settings, you can see where is that? So there is a two values in the setting. You can see that and the overbought value is that 70 and the oversold value is 20, 30. So above 70 it is considered overbought. Stock, a coin will be considered overbought, and below 30 it will be considered oversold. So what I'm going to share is how can you use it better than the knowledge you have already. So first, let's talk about the general settings of this. So the general setting is 14. That's mean it includes the data of last 14 candles. Source is considered close. There is a moving average type, which is I don't use usually. So I'm just gonna remove it from here. And yeah, this I'm gonna uncheck it. And now we have this values. So the RSI upper band value is 70. The middle band is 50, and the lower band is 30. Below 30, it is considered oversold, and above 70, it is considered overbought. So, and it tells you the momentum. So, the value is oscillating between these two values, and sometimes it goes above 80, 90. So, I'm going to tell you how to use it correctly. Don't just consider above 70, you just sell it. So, what usually first, let's compare this how people use it usually. So, what they do is once it goes below 30, people start buying. So it goes below 30, people start buying, and when it goes above 70, people start selling. If you're doing derivatives, you might start shorting it, but I wouldn't recommend that. That's how people use it. Now, what is different? Why I'm saying I'm going to tell you the correct use. So once it goes below 30, you don't just buy there. You wait. You wait for it to go back above 30. This whole thing, you won't buy this. So you might miss the exact bottom, but it doesn't matter. You won't be holding a bag. So you wait for it to go above 30. Now you buy here. So once you buy here, let me show you. So you are waiting for it to go above 30. So you are going to buy here. Oh, that's a short pull. Sorry. Here is the buy to. So you're going to buy here, and I'm not going to tell you that you are going to use a stop loss here or everything, but that would be a trade you will take on your own risk. Don't just take a trade on the basis of RSI. That's not what I'm trying to say. So you are going to buy here, and then you can sold sell it once it goes above, once you achieve your desired value. So I should have used the measurement tool instead of this. So you are going to buy here. So once it goes above 30, and that is here, I guess. Yeah. So you're going to buy here, and then you can sell it when it goes above 70 or at your desired value. So you can see how it gives you a 17%. So if you have bought once it went below 30, like around here, you would have been in like a 10% loss, and you would have made some gains once it goes above, but that would have been like half of the gains. So you can see how different it is. Now again, we are going to discuss for the oversold thing. So I'll consider it oversold when it goes above 70. So this is where it goes above 70. this here, you can see this, it goes above 70. So yeah, this. So you're going to sell your target, that would be your target, or you can short sell here if you're looking to derivatives. But you can see how high it went above that. So what I'm saying is, you don't just sell here or you don't just short here, you wait for it, go come back below 70 band again. So this is where it comes back below 70, and you can say that you can see how quickly it gave you like 4 or 5% move, and then it went above 70 again, and here it went below the 70 again. So you could have sold here again. Yeah, here, yes. So again, you could have made some gains, 1 2%, but again it would have went above and then came down. So that is why I'm saying that you don't just use RSI for trading purposes, you just use it for another conference. Usually what I do is that I use it for divergences. How to find a divergence? Divergence, there are different type of divergences here. There is hidden divergence, there is normal divergence, and bullish divergence, bearish divergence. So what we do is that, let me quickly find a divergence. All right, so here we have this divergence here. So you can see RSI made a high and then it made a higher low. While during this, what price did is price made a high and it made another higher high. So this is called bearish divergence. Now this bearish divergence will play out and you can see how it came down after that. And so this is called the bearish divergence. Now I'm going to look for a bullish divergence. I don't seem to find one here. Let's see. Okay. All right, we have the bullish divergence here. So you can see RSI value depends on the closing. It does not just it consider the price closing. So you can see price made a lower low while RSI made a lower high. Now after that you can see how price started going up, and this is the bullish divergence. So this is how you can identify divergences and you can play them as well. So this is how I use this indicator. I hope this video would have been knowledgeable for you. Do comment about it. Do give me your review about the videos, and do let me know if you want content like this, which can help you learn about technical analysis. So if you like it, please share this and please like the video so that I stay motivated to upload more videos. Thank you so much, guys. Have a great week. Thank you.